Okay, thank you everybody for joining me. My name is Dan Maga. American College Funding is the name of my company. I started the business back in 2004 with my father, who's since retired. So it's just me in the practice. And I work with parents like yourselves and helping them figure out how they're going to pay for their children's college education. So the webinar tonight hopefully is going to, inform you on what you have faced ahead of you in terms of planning and preparing for paying for your kids' college educations. Now, I am going to keep everyone on mute during the webinar, but please feel free to post any questions in the Q&A as I'm going along. And then at the very end, I'm going to answer as many of those questions as possible. So I like to call this how to become an informed buyer of college, or college and retirement. You can do both. Ideally, anything that you can save on your kids' college education can be redirected for your own retirement. And I like to start with a little quiz. What percentage of incoming freshmen will graduate from that same school with a 4-year degree? And according to US News and World Report, only 41%. Only 19% at most public universities, or 36% at the state's flagship university, or U of I in our example. So obviously anything that we can do to help get our kids done in 4 years, or maybe even less, is only going to reduce the financial burden for mom and dad. And as you know, the cost of college has been skyrocketing over the years. And when I talk about the cost, it's not just the tuition, but the cost of attendance includes the tuition, fees, room and board, and then the estimated expenses for books, travel, and that sort of thing. And when you look at the low end of the cost of college today, say at our Eastern or Western Illinois, you're looking at around $25,000 a year or $100,000 over the 4 years. And on the flip side, we've got a number of schools like Northwestern and University of Chicago who have surpassed $80,000 a year. So you could be anywhere from $100,000 to $320,000 for one 4-year college education. And to make matters worse, this is going to be paid with after-tax dollars, meaning you've got to pay Uncle Sam first before you pay for college. So if you're in the 33% tax bracket, you've got to earn $150,000 to have $100,000 left to pay for college. So a lot of what I'm trying to help my clients with, especially those that are self-employed or have their own business, is showing them how they might be able to pay for a portion of college on a pre-tax basis. And if we can do that, it's going to make things that much easier when it comes time to pay the bills. The effect of college on retirement or lost opportunity cost. Opportunity cost simply means it's not just the value of your dollar today, but what that dollar could be worth to you into the future. Or as it relates to college, it's not just the money we're spending on college today, but if we could save some of that, not just the savings today, but what that could be worth to us into the future. And I know it's crazy to use a 7.2% rate of return based on what's been going on in the markets lately, but the reason I do that is because if you garner a 7.2% rate of return, your money will double every 10 years, meaning it's not just the $100,000 you're spending today on college. If you're going to live another 40 years, that could be worth $1.6 million to you. So anything that you can do to save money today on college, it's not just those savings today, but what it could be worth to you into the future. And a couple key things to remember. You can't borrow for retirement, you can't get a scholarship for retirement, and you can't use your child's income for retirement. These are all things that you can do right now to potentially pay for a portion of college. Okay, some keys to success. Educate yourself like you're doing tonight, right? Don't assume anything. Don't assume because your friend said, don't bother filling out the FAFSA that you shouldn't fill out the FAFSA. Or don't assume because your coworker said, ooh, Alabama's giving out a lot of scholarships, that your student will get a scholarship from Alabama. You need to be cognizant of your situation, both as it relates to your student academically, as well as you financially, and then how that correlates at the colleges that your student is targeting. And the reality is that just might be different than your friends, neighbors, and coworkers. Evaluate, know your expected family contribution, or EFC, and the college's award history. EFC is a key term you're going to hear throughout this process. The EFC is basically the amount of money the school thinks you can afford to pay for college. So the lower your EFC, the more eligibility for grants. The student is then eligible for a need-based grant on the difference between your EFC and the cost of attendance at the college. So, for example, let's assume your EFC is $40,000 and your student wants to go to Indiana University and they cost $55,000. You'd be eligible, or the student would be, for $15,000 of grants. But then we have to look at the school's award history. And Indiana, for example, does not typically offer institutional need-based grants. So although you qualify for $15,000, more than likely Indiana would leave you with the full bill. Now, the student may get an academic merit scholarship, but unlikely Indiana would give a need-based grant. So you not only have to know what your EFC is and how that correlates at the pricing of the schools your student is targeting, but you also have to have an idea on the college's award history. So if you do qualify, how much of that money they're actually expected to offer you in the form of a grant. Just because you qualify, they're not obligated to give you anything. It's up to them to determine, them being the college, how much they want to offer in a grant or a loan. Generally speaking, the private schools are going to be more generous in terms of grants than the public schools. And then execute, or once all the facts are known, hopefully a strategy can be put in place to pay for this and preserve as much of your assets as possible. Okay, the SMART approach, or the ABCs. First things first, I think everyone should apply for financial aid. It's free, it can only make money available to you. Become cash flow efficient. Obviously, this is going to be an expensive time. Maybe you're looking at the budget, seeing where you can trim a thing or two. Credit opportunities. I'm going to talk a little bit about what money is going to be available to the parent and the student in terms of federal loans. And then the last thing I think you should do is deplete your assets. Okay, everybody recognize him? Bill Gates, right? Even I qualify for college financial aid. If Bill qualifies, do you think you qualify? Obviously, right? So Bill and his kids qualify for the private student signature loan, the parent loan for undergraduate students, and the unsubsidized student Stafford loan. And there's only one requirement that Bill and his kids have to meet to be eligible for that, and that's complete the infamous FAFSA form. Best thing about FAFSA, the first F stands for free. Free application for federal student aid. Without the FAFSA, the kid is not going to be able to take advantage of any of the items I've listed on the screen here. First and foremost, need-based grants and scholarships. That's what we all want. Can't get that without the FAFSA. Federal loans, both the subsidized student Stafford loan and the federal Perkins loans, these are 0% loans in the student's name. Federal work study, that's the college giving the kid an opportunity to work on campus where they could earn some money that could be used to pay for their college education. Unsubsidized student Stafford loan, another federal loan in the student's name, current interest rate fixed at just under 5%. Private student loans, so that would be like going to a bank, Wells Fargo, Discover, whomever. Generally speaking, the bank is going to require that a FAFSA be completed to be eligible for their monies. And then the PLUS loan, or parent loan for undergraduate students. This will be a loan in mom or dad's name, current interest rate fixed at 7.5%. And then unfortunate things happen, like what we're going, with the COVID thing that we've been dealing with for years, right? Let's assume a couple of years ago, your kid was going off to school and you didn't fill out the FAFSA, you were just going to pay for it. And then COVID hit and you lost your job, and your situation now is dramatically different than it was a few months prior when your student was applying to schools. So now you call up the financial aid office and say, hey, my situation has changed. What can you do to make aid available to me now that I've lost my job? And what do you think the first question that financial aid officer is going to ask you? Did you fill out the FAFSA? If you did, great. Here's our special circumstances form. Please complete it. We'll reevaluate your situation, see if we can make grants available. But if you never applied in the first place, well, there's nothing they can do until next year. So I also kind of look at it as like a mini insurance policy in case something within your situation changes, allows you to go back to the university and ask for some help. Okay, now to make things even more confusing with this EFC, or expected family contribution, there's actually going to be two formulas used to calculate it. The federal formula, which is used for most of the schools out there, and the institutional formula. This is used by like a couple hundred schools that require an additional financial aid form called the CSS profile. Northwestern, Michigan, University of Chicago are a couple local examples. The Ivy League schools would fall into that category. So, if your kid gets into U of I and Northwestern, The EFCs could be different because those two schools are using two different formulas. This is a quote from Kalman Chaney that I like to read before I get into the financial aid section. You might think that the families who receive the most aid would be the families with the most need. In fact, this is not necessarily true. The people who receive the most aid are the people who best understand the aid process. And having gone through this the past 18 years, this could not be more accurate. Now, how do you apply for financial aid? First things first, whether your kid's going to Oakton or Harvard or anywhere in between, you got to do the FAFSA form. If they are applying to Harvard or SMU or Stanford or Lawrence University, then you're going to have to do the CSS profile too. And then some of these schools, in addition to these forms, can have their own institutional forms or worksheets that they're going to want you to fill out. And if the CSS is required and one of the parents or both are self-employed or have their own business, the business farm supplement could be required, as well as if the parents are divorced, the non-custodial profile form can be required. So as an example, if you're divorced, let's assume that mom and dad are divorced and the kids live with the mother. If that is the case, then mom is the one that is completing the FAFSA form with her information. And she's not going to report anything about her ex-husband or the father, assuming she is not remarried, on that FAFSA form. The only thing that she's going to report about her ex-husband would be any child support or alimony that he provided her during the previous year. But outside of that, his information is nowhere on that form. The only reason his information would come into play if the student applied to a school that required the non-custodial profile form, then dad or the ex-husband in this example would have to fill out his own CSS profile form, and his information would be taken into account when determining if the student qualified for financial aid. Okay. Need-based aid, you must qualify for this. The main things that they're looking at here is your assets, your income, how old you are, how many kids are in your family, and then how many kids are in college at the same time. And those are the key factors that are going to determine your EFC. And one that people often overlook is the number of children in college at the same time. Let's say, for example, you've got two kids, first student comes along, your EFC is $90,000. Well, that's above the cost of any college today. Not going to be eligible for grants. But if 2 years later, your second student comes along, now the EFC is $90,000, but it's split between the two kids, $45,000 per student. And as we unfortunately know, there's a heck of a lot of schools out there that cost more than $45,000 a year. And in that example, if the kid was going to one that did, then he would qualify for the last 2 years. So that's why you can't simply say, oh, I make $200,000 a year. I'm not going to fill this out. I'm not going to qualify. Not necessarily true. You know, you could be making $400,000 a year. And if you've got multiple kids in college at the same time at high-priced private schools, you may qualify and receive grants. And on the flip side, you could have one kid going to school and make $100,000 a year and, you know, get nothing from Illinois. Because another thing you got to keep in mind is, as to whether or not you qualify, how expensive is the school? Meaning, if your EFC is $60,000, well, you're not going to qualify for grants at Illinois and Michigan State and Indiana and Wisconsin, because they all cost less than that. But if your EFC is $60,000 and your student wants to go to Northwestern or Tulane or SMU, well, then you would qualify for $20,000 plus, because those schools are all $80,000 a year. So yes, obviously your finances play a major part in whether or not you qualify, but how expensive are the colleges and how many kids are in college at the same time are two other key factors that people often overlook. Here's a quick little example. Let's assume you've got a $75,000 cost school. Your EFC is $58,000. That means that student has a $17,000 financial need. If the college required that you report any private or third-party scholarships, let's say the student got a $2,000 scholarship from their church, then the college adjusts the need down to $15,000, meaning if the school requires that you report private scholarships, and if you qualify for grants, it's possible they could reduce your grant proportionally by the outside scholarships that your student receives. Now, if you don't qualify for grants, or the college doesn't require that you report them, well, any outside scholarships obviously are just going to help reduce your bottom line. Okay, understanding the facts, the type of assets you have and the ownership of these assets. So When you're filling out this FAFSA form, there's going to be a parent section and there's going to be a student section. It's critical to realize what's a parent asset, what's a student asset. For example, a 529 savings plan that has both your name and the child's name on the statement, that's going to be considered a parental asset. Whereas a custodial account or a UTMA, UGMA account also would have your name and the child's name on the statement, but that's going to be considered a student asset. And within their EFC formula, they're going to count the parent assets against you as 5% and the student assets at 25%. Much more penalizing to have money saved in your student's name versus your name. And you're going to be reporting those asset values as of the day you submit the FAFSA. So if you've got a junior in high school right now and you don't have to complete the FAFSA for 10 months next October, it is possible you could move money from A to B to reduce the EFC, garner more grants from the colleges. Now, another key thing to realize, they're going to ask you on the FAFSA, what is your net worth? Now, there's a lot of things within our net worth, though, that FAFSA doesn't even want to know about. Namely, any equity in your home and retirement account values. So the primary residence, as well as IRAs, 401ks, cash value life insurance, annuities, defined benefit plans, SEP IRAs, none of that has to go anywhere on the FAFSA form. Now, the institutional methodology, this is the one that the schools use who require the CSS profile. A little bit different. They are going to ask about your home. So they're going to ask you, what year did you buy it? What'd you pay for it? What's the estimated value? And what's your mortgage balance? And the difference between your mortgage balance and the value that you estimate, or that equity, they're going to factor into their calculator just like it's cash in your checking account. So if you have the unfortunate responsibility of filling out this form, I wouldn't go out of my way to overvalue my home and inflate that asset that then they're going to take into account when determining if your student qualifies for financial aid. Okay, so for the timing of this, the senior year of high school, October 1st is when you can submit the FAFSA. So if you've got 2023 grads now, you could submit the FAFSA tonight, or you could have done it, for the past 2 months. If you've got a 24 grad, you won't be able to submit it until October 1st of next year. So any October 1st or after is when you can submit the FAFSA. Now, unfortunately, although that date is universal, there is no universal financial aid deadline. That's going to differ school to school and based on how the student applies. Early decision, early action, regular decision, returning student. So you'd have to check the college's website to see specifically when it's due for you. But generally speaking, if the student's applying early decision, it's probably due mid-November, early action, early to mid-December, regular decision, January, February, and then returning student, March or April, just as a general guideline. Now, in order to submit the FAFSA, both the student and one of the parents is going to have to create what's called an FSA ID. That's going to be like the way to electronically sign and submit the form. As I've been talking about, you got to understand the instructions on how to complete this thing. Parent asset, student asset, that sort of thing. And you have to do it every year for every kid. So you're not just doing this once. If you've got 2 kids, hopefully they both graduate in 4 years, you're filling out 8 FAFSAs over the time period. Now, although the assets are as of the day you fill out the form, income is a little bit different. They're going to look 2 years back. So if you've got a senior in high school right now for their college freshman year, that FAFSA that you're filing now is going to be based off income you earned back in 2021. If you've got a junior, then that income is going to be based off of this year, 2022. So 2 years back in terms of income, day of, and in terms of assets. Now, as I said, in terms of timing, like everything else, you're going to want to do this online. And you can do it on or after October 1st. So if you've got seniors, you can do it now. And if any of the schools your student is applying to is going to require that CSS profile, you'll want to make sure to go ahead and get that done. And have the kids monitor their financial aid portals on the college's website, because it's not atypical for these schools, even after submitting both of those detailed forms, to ask for more information. And usually they'll put that in the kids' portal if they want more details. And then be prepared to send your tax returns. A lot of schools are going to want to see copies of your tax returns, so be prepared to send those over. So at this point, let's assume that your student has submitted the admissions applications, you've submitted the financial aid forms, the FAFSA, the profile. The next thing you're going to do is you're going to start receiving award letters. Now, the award letter is going to detail everything from the cost perspective, what they're going to charge you for tuition and fees and room and board and all of that, and then everything that they're willing to offer: grants, scholarships, loans, work study. So you can see exactly what the net cost is going to be for each school that accepts the student. Now, if you do not apply for financial aid, you will not receive an award letter. But if you do, the student would then get the award letters from all the schools that accept them, and then they would get to decide from there, typically by May 1st, assuming they do not go early decision, where they want to attend. Here's an example of an award letter from a client of mine this past year. So this is for Indiana University. You can see that their cost at that time was $55,740. This student received a $10,000 academic merit scholarship and was offered a $5,500 federal loan. So if they accepted the loan and the scholarship, you can see at the bottom, the net cost was just over $40,000 for the freshman year at Indiana. Same student was accepted to WashU, which is far more expensive than Indiana. As you can see here at the bottom, it was over $83,000 last year. But they were also far more giving, a grant of almost $47,000, and then the same $5,500 student loan and a $2,500 work study option. So if they accepted the loan and the work study and the grant, the net cost at the bottom for the freshman year at WashU was $28,690, or almost $12,000 less than Indiana, a lower price school than WashU, but for this family, WashU was actually far more affordable. So basically saying, look, depending on your situation, you may not necessarily want to rule out these higher priced private schools because they may end up providing more funds than the lower priced public universities, depending on your situation. Okay, what would it be worth to know how to save $33,000 on any four-year college your child chooses? So this is how mom and dad can save $33,000 per student. Most kids get off about 15 weeks during the summertime. If we can convince our kids to work, earn, save $100 a week, that's $1,500 a year, or $6,000 over the 4 years that they can use as they're spending money and they're not calling home asking for it for mom and dad. The federal student Stafford loan. This is the loan I talked about earlier. This loan is available to every student, no matter what, as long as they fill out the FAFSA form. You, me, Bill Gates, and everybody in between, as long as the FAFSA form is filed, this is available to the student. And these are the loans they're talking about right now that are being forgiven. So the max that the student can borrow over the 4 years is $27,000. That's broken down by $5,500 the freshman year, $6,500 the sophomore year, $7,500 the junior and senior year. They have to start repaying the loan 6 months after they graduate. If they go into graduate school, the loan is deferred until after graduate school. But if they don't go to graduate school and they graduate and start repaying the loan, it's about a $250 a month payment amortized over 10 years, principal and interest. The interest is tax deductible to the student, and there's no prepayment penalty on the loan. So kind of like a mini mortgage in that sense. So you can always pay it off early. Interest rate. The unsubsidized interest rate is fixed at 4.99%, and the subsidized rate is 0. How do I get the subsidized loan? For the student to qualify for the subsidized loan, your EFC would have to be below the cost of attendance of the college, or you qualify for financial aid. If that's the case, then they can subsidize all but $2,000 a year on the numbers you see on the page there. So if you qualify for financial aid as a freshman, the student could have a $3,500 subsidized loan at 0%, and then a $2,000 unsubsidized loan at 5%. Bill Gates's kid can borrow the same $5,500. It would just be all unsubsidized at the 5% rate. So There's a couple ways I think you could use this to your advantage. Obviously, if the student takes on the loan and repays it, well, it saves you the 27,000. Or look, maybe you don't want your kids to have student loans. Um, Maybe you're saying, look, based on what the market's doing, I don't know if I want to cash in my money now. I'll borrow it from the government at 0.5%, and then I'll pay it off later. Or maybe you think they're going to forgive more of these loans in the future. So you say, all right, let's take on the debt now. I'll carry the interest cost if I have to. If they forgive it, great. If they don't, I'll pay it off. So there's a couple ways I think you could use this to your advantage. And the only requirement is you got to have a FAFSA on file for the student to have it available to them. The only other thing I would point out is for better or worse, the most that student can borrow as a freshman undergraduate is the $5,500 you see on the page here. So don't let your kid say, Mom, Dad, I want to go to Michigan, not Illinois. I'll borrow the extra 30,000. Don't worry about it. The problem is no one's going to loan the money. Now they can get the $5,500 loan, but if they want to borrow an extra 25,000, now they got to go to a bank to get it. And the banks just aren't loaning 17 and 18-year-old kids going to for an undergraduate degree who have no money and no credit money to go to college. Now they'll loan you the money, or they'll loan you the money if you co-sign on the student's loan, but the student borrowing it on their own signature above the 5,500 is going to be very difficult, if not impossible. Although if they do go on to graduate school, at that time, then they can take on federal loans that would cover the full cost of graduate school, and you wouldn't have to worry about co-signing on any of those loans. Okay, a couple myths versus reality. Oh, I make too much money, I'm not going to fill out the forms. Hopefully I've dispelled that, right? Everyone who fills out the FAFSA, there are some advantages. And obviously, maybe you qualify even though you think you don't. I'm not going to qualify for financial aid. I got this $1 million home that's paid off. They're never going to give me any money. Not necessarily true, right? The FAFSA form, you don't have to report equity in the home. I got a lot of debt. They're going to look at me more favorably. They're going to give me financial aid because I got this credit card debt and some car loans. They don't care about any of that. They only care about your income and your assets, not your debts. Getting financial aid is easy. Look, there's no doubt that they are trying to make this system so that you can complete the forms accurately on time and get what you're deserving. But I also don't think that there's a question that it's super confusing and they're changing the rules every year. And some schools have different requirements than others. Now, I'm definitely not saying it's not impossible for a parent to do it on their own. But a lot depends on the parent too, right? People who are, maybe better at filling out forms and numbers and things like that, or this is going to be an easier task for them than someone who isn't that type of person. The student will get more aid if independent. This is a great one. If you were reading the news a couple years ago, there was an advisor in the western suburbs who was advising their clients to relinquish guardianship of their kids so they could claim that they were independent for financial aid purposes. Now, as you can imagine, when that gets written up in the papers and the Washington Post and what have you, probably not a strategy that you would like to implement in order to try and claim your student as independent. More than likely, it's probably not possible for your undergraduate student to be considered an independent. Here's a couple examples of what they would have to do to qualify as independent outside of relinquishing guardianship. If they're 24 years old, if they are honorably discharged from the service, if they're homeless, if they are married with a dependent, if their parents are deceased, just things that probably, for most people, it's not going to work out as being able to claim them as an independent. You can't just not claim them on your tax return and then assume they're independent for financial aid purposes. There's a much stricter guidelines to qualify. My student won't qualify for an academic merit scholarship. Oh, my student, he doesn't have great grades or test scores. No one's going to give him a scholarship. Not necessarily true. The reason I know that is there are schools out there that give scholarships to everyone that applies. Now, don't come to me with a student who has a 2.0 GPA and think that, I'm going to tell you they're going to get a scholarship from UCLA. That's not realistic. But what is realistic is finding schools that, regardless of what your student's GPA is, whether it's 2 or 4 or anywhere in between, wherever they're lining up at the top of that incoming class, maybe like a safety type school, something like that, those are probably going to be the schools that are going to be more likely to offer an academic merit scholarship. And the good news is we can predict what those numbers are going to be prior to your student applying if that would be valuable information to you. Here's a couple examples of some kids of mine from a few years ago who all had above a 30 test score in the annual scholarships that they received. And in my mind, knowing what the schools are going to provide the student before they apply is critical in terms of being able to plan for what you're faced with. And we can predict this type of information. And again, it's wherever the student is kind of leaning into at the top of that incoming class, that's more than likely going to be a school that has a potential to offer a scholarship. If it's a reach type school that you're not sure they're even going to get in, well, then that's probably not a school that's going to offer the student a merit scholarship. In an academic merit scholarship, for the ones I'm talking about, at least, they're generally automatic. So the student's not applying for the scholarship per se, they're just applying to the school, and has nothing to do with financial aid or the parent's income and assets. It's all in the student's grades, test scores, that sort of thing. Okay, here's a little case study, and then I'm going to wrap it up and address any questions. Again, if people have questions on anything that I haven't covered or have covered, you have a question on, please post it in the Q&A, and then when I get done here, I'll try and answer as many of those as I can. So this was a client that came to me. Their first student had just started at University of Illinois, and then they had a kid that was 1 year behind that wanted to go to Northwestern. They'd saved some money for college, but they didn't have enough saved to cover both schools, or as well as the fact that they couldn't afford to cover both schools' costs out of their income. Here's an example of what their financial situation looked like. Their income was $275,000 a year. They had $100,000 saved for college, $750,000 in retirement, $50,000 in savings. They had a $300,000 mortgage on their home. They borrowed $25,000 on the PLUS loan for the first students at Illinois. They weren't sure how to pay for it, so they used the loan. And they had a car loan of $30,000, and they felt they could afford about $1,000 a month out of their income without affecting their lifestyle to pay for college. But unfortunately, although they'd saved $100,000 and could afford $12,000 a year, it wasn't going to be enough to cover both schools. And because they determined, look, if our kid gets into Northwestern, we'll figure it out. We'll pay for it. We'll borrow it if we have to. And that's what they had to do. I suggested they borrow the money out of their home. So they took on a new mortgage and then paid off the old debts. And now they had $100,000 of tax-free capital available to pay Northwestern and Illinois when their funding ran out. But please understand, had the second student decided to go to Illinois, there would have been no reason to remortgage their home. They had enough money to cover it. The only reason that they had to do this is because they didn't have enough money to pay for college, and they had to come up with it somehow, some way. The benefit to the mortgage is the fact that it's typically the lowest interest rate and you get the tax deduction. There was also an advantage by kind of positioning themselves early as a way to reduce their expected family contribution, or the EFC. Now, this didn't really matter at Illinois, who generally doesn't do a very good job of offering grants, but for Northwestern, who meets 100% of demonstrated need in the form of a grant, when I reduced the EFC from $60,000 to $45,000, that's just an extra $15K a year in grants from Northwestern. So super powerful if you can reduce your EFC at these higher price private colleges. And here's what the offers look like. So for Northwestern, the grant was almost $35,000, so that after the student loan and their college fund and the child working and their income, they were about $20,000 short. For U of I, there were no grants, just the student loan and the college fund, and the child was working in their cash flow, and they were about $11,000 short. And that $30,000, that's what they dipped into the home to meet the expenses to pay for both schools. Perfectly legal and ethical to do all this. It's just understanding not only the system, but where you fit within that system. And if there's a way to maximize the students' grants and scholarships, I want to point that out to you in terms of how you're going to do that. Because if you can increase the grants and scholarships from the schools, well, that's just going to reduce your net out of pocket at the end of the day and make things that much easier when it comes to paying for college. Now, that's pretty much it for the webinar. Like I said, if anyone has any questions, please post them in the Q&A. And I'm going to go through those right now. Or, feel free to text or call me or email me. Email is probably best if you have questions about anything that I covered or did not cover. Happy to address any questions you have, after this, if you'd like to email me later. I'm currently out of town, but I'll be back later this week. So it may take me a couple days to reply, but I will reply as quickly as I can. Okay, so first question, can you explain the difference between the FAFSA and setting up a CSS profile via College Board? So they're going to be two completely different websites. The FAFSA website is studentaid.gov, and that's the one where you're going to need the FSA ID for both the student and the parent. Whereas the CSS is through the College Board website. If you just Google CSS profile, it'll come right up. So they're going to be two completely separate logins. More than likely, your student already created their own College Board login and password. And if you try and create one for them and they already have one in place, it'll kick you out and you'll have to go through the reset password sort of thing. So more than likely your student already has a College Board account. Unlikely they did their own FSA ID without you, helping them. So hopefully that answers that question. I've been noticing how much cheaper it is to attend college in Europe versus the US. Have you seen more of an uptake of high schoolers applying to colleges, universities in Europe? I do get a number of kids, I will say, that do apply to schools overseas, but at the end of the day, most of my kids end up staying in the US for various different reasons. But, I've obviously had a few over the years that have gone to school overseas, and the most, a lot in Canada, I would say, is the most popular. But you can definitely find some value over there for sure. So, I wouldn't plan on the schools providing any grants or scholarships. I would just look at the sticker price of the college to try and gauge what it's going to cost you to send the student there. Which annuity is not considered? Qualified IRA or any annuity? So for the FAFSA form, any annuity, you do not have to report on the FAFSA form. Now, for the CSS profile, if the annuity is qualified or within an IRA, you would not have to report it. If it's what's called a non-qualified annuity, then you would have to report it on the CSS profile, but you would not have to report it on the FAFSA. Do you have any advice for a freshman college student who is planning to transfer to a different college? Any issues with receiving financial aid at the new school? So no, in terms of transferring, so, let's say you don't know where they're going to go. I would be submitting a FAFSA right now for the schools where they may end up going to school. And their financial aid isn't going to be any different at that university as a transfer student as it would be as a returning or an incoming student. So that's not going to have any effect. Now, I will say that the academic merit scholarships that schools offer, it's kind of two different pools. There's for the incoming freshmen and for transfer students. So you may get a different academic merit scholarship offer than the student would have had coming right out of high school. But financial aid, you shouldn't see any differences. Does the information you submit in the FAFSA go into some federal database that is sold, et cetera? No. And as far as look, I've been doing this for a long time and, tons and tons of clients. I've never had anyone say that, they got hacked or anything like that because they sent information into the FAFSA. Now, again, you're going to have to rely on the Department of Education and their security in terms of what's in place there. But at least from my experience, I haven't had anyone have any issues in that regard. Is it better to put money in? Is it better to put money own investment account or student, I think 529 plan? So the question is, or I'm assuming the question is, for financial aid, is it better to have money in an investment in the parent's name versus a 529 for the student? And there's no difference, actually. The 529 value versus if you have investments in your name and, stocks, bonds, mutual funds, that sort of thing, they are going to be valued one and the same for financial aid purposes, which is basically at that 5% rate in terms of the EFC formula. What happens if you no longer own your own home and you now rent? Does this help with the FAFSA? No, because you don't have to report your home or your rent, or if you're renting. So it has no effect whatsoever. Who do we go to for help if we need filling out the FAFSA? Well, you can contact me. I fill them out for my clients. So you could, like I said, you could email me, or maybe you could ask your accountant. Some accountants help with that. But yeah, I mean, that's a service that I provide, is completing the FAFSA and the profile forms. What about students that have dual citizenship to another country? What are the benefits to study overseas? That's going to depend on the schools. You're going to have to check with the college to see, based on their citizenship, if that gets them a reduced rate, which is definitely possible, but you may get different answers at different schools. So you want to contact the college directly to kind of see where you fit in terms of if there's going to be a price break. Would 529 account impact how much aid you get? To a certain extent, yes, because the value of that 529 plan account is going to get factored into the EFC formula at that 5% rate. So if you've got 100,000 saved in the 529, they're going to think 5,000 of that, or 5%, goes into that EFC formula in determining how much you qualify for in terms of grants. And again, if you have questions on that, I mean, I can help predict what they're going to offer grant scholarship before your students apply, if that is valuable information to you. If you don't have enough saved, your students saved in a 529, they're a junior in high school, is it better to save in a 529 or private investment vehicle? That's just a hard question to answer, quite honestly, without, kind of meeting you in person and getting more information. So I'm sorry, but hard to give you, an accurate answer on that, depending on your overall situation. Any other questions out there? All right, well, look, if there's not any more questions, hopefully this information helped. Like I said, if you have other specific questions you'd like me to address, feel free to email me and I will reply to that as soon as I can, and hopefully get you the answers that you are looking for. So thank you everyone for attending, and have a great night. Oh, wait, sorry, hold on, a couple more came in here. So is it best to put as much money into retirement funds as possible? Again, another question that's really hard to answer without more information. Technically, yeah, yes, in the sense that money in retirement accounts is not counted against you in the formula. But keep in mind, if you're not going to qualify for financial aid, then it doesn't matter. There's no reason to jump through the hoops. The other thing to keep in mind is any money contributed to a retirement account, IRA, 401k, that sort of thing, they will add back as untaxed income. So if you ramp up your 401k or IRA contributions, thinking that it's going to increase or decrease your EFC because it reduces your income, that's not true, because they add it back in as untaxed income. If a divorced person remarries, is the new spouse's income considered? So if a divorced person marries and that divorced person is the custodial parent for the student, or that's where the kid lives with, then yeah, let's say mom got divorced and she got remarried and the kids live with her. So when she fills out her FAFSA, she's gonna include both her income and her new husband or the stepdad's income. Will you share a recording of this presentation? Sorry if you already stated this. Yes, I'm recording it right now. My plan is to get that off so they can post it on the Nutria Parents Association website, so you can watch it whenever you want. So yes, it is being recorded. How many percentage of cash position into EFC? 5%. Remember, 5% for parental assets is counted within the EFC. Do grandparent contributions count as income or affect EFC? It wouldn't affect the EFC. Now, if they're contributing, I guess it depends on how the grandparent is contributing. If the grandparent is contributing directly to the college, it wouldn't affect FAFSA or anything like that. But it is possible that the school, if they notice it's coming from like a third party, they could treat it as a resource and reduce grants dollar for dollar. Now, if the grandparent is contributing into your 529 plan, then their contribution would count within the asset value that you have to report. For a non-custodial parent, is 529 considered parent contribution as opposed to child? So if the non-custodial parent has a 529 account that they own, that would not have to be reported on the student's FAFSA because the custodial parent does not own it, so it's not their money, so they wouldn't have to report it on the FAFSA. All right, so again, thank you everybody for coming. Hopefully I was able to answer all your questions, but if you have more, please feel free to jot down my email and send me an email with any other questions you may have, and I'd be happy to address those as soon as I can. So thank you everybody, have a great night.